Hi, Keith and Simon at Portfolio Matters. Good to see you again.
Yep.
And
Great to see you, Ray.
I've done what we'll do is just go through the basics, the S&P 500 and the UK, and then the macro. Then I'll pop through a couple of little positions I have at the moment, and then we can talk about the fiat banking system.
Great.
So start off now. Can you see this okay?
No.
Right.
Oh, hang on. No.
So, I'm sharing my screen. Yeah.
I've got the recursive screen of death. So,
Okay. Now, can you see?
Aha. Yes.
Okay. So you can see the
Yep.
Joe
PM
Biden
call,
falling down the
December
stairs.
2024.
Okay.
Yeah.
So, so we can start with the S&P 500, which has continued on its thunderous run, and I've got this long-term chart here because I have a kind of base case that the there's a link really between the S&P 500 growth long term and total money supply, and that the fiat capitalist system, or fiat based global capitalist system, involves just printing more and more money, and almost through inflation. This is great for stocks. And then when we zoom into a bit more closely here, this long term, we're actually ever since we entered full New Keynesian economics, we saw a ramp up in the gradient. Then ever since the corona, the corona outbreak, and then all of the more money being pumped in, we see the actual it's steepen here, and we're currently still in this steepening trajectory here. So as far as I'm concerned, we're in like this 16% yield. And when I look at the macro, I'll ask. Okay, first of all, I'll ask Simon, what are your thoughts? Because you're a good technical guy. What are your thoughts technically on that?
Yeah, I agree with your change in gradient. So the long term has been 7%, and which is your very bottom blue line. And then if you go back to the previous
green line.
chart.
Yeah.
Yeah. Okay. Well, is it the bottom one, which
So
is the
yeah, it's the
7%
bottom one there, and on here it's a green line here. That's the same.
Okay, so 7%. And then your next line should be about 16, and then the current trend, which is topping the 16 upper trend line, is about 23% per annum.
Yes, and when I drew this, it looks like we've broken to the downside of that channel.
Well, yeah, that as Keith will recognise in my own chart, in that little the interest rate 50 basis point cut happened a few days ago, and it's kind of trying to keep above that double top resistance line. Now, for me, I mean, yeah, it could historically, because you've got on the FANG bubble, it could keep above that 16% trend line for a bit, but I'm a bit queasy up here, to be honest. So I'm out of both triple Qs, which is definitely trending down, and the S&P as markets. But I still keep my individual stock positions. So,
well, congratulations, Simon. You've done very well. So we're off the presentation. We're watching your
charts. I've just loaded up the
charts.
chart as we were talking about it, and I mean, I agree. I'm a little uncomfortable, but myself, I find this 21% you said gradient impossible, too good to be true, you know. But I kind of favour us now falling along line this 16% gradient, you know, and until there's the next major disaster or something, whenever that is, which could then even just send us to the bottom of this channel with a 16% drop. So, you know, that would kind of make sense.
Yep. Yep. That's all fair enough. Yeah, I mean, it's a bit unpredictable now until the election's over. But, you know, if one side gets in and says corporate taxes are 15%, and the other side gets in and they say that corporate taxes go up to 28%, I mean, right there, you've got a bit of arbitrage into either the S&P 500 taking off further or diving down into the base of that trend line. So I think the corporate tax issue could, depending on the president and the next president and their policies, that could be a mover. I don't know anything else that could be a mover, because right now we're all debating whether interest rate cuts are good for the economy, which wasn't the case before, because interest rate increases were also good for the economy. So
Yes,
it's a bit difficult to know in this topsy-turvy world.
Yes, MMT has, you know, the fact the US deficit, US public sector debt is now so enormous. When you raise interest rates, as they have done, what you do is the interest payments on that enormous debt get pumped into the economy. And the FT were reporting that the rise in interest rates in the US had made the US banks $1 trillion. It's just absolutely astonishing, because they're getting 5.5% on, paying out 2.5% on their deposit, 2.2% on their deposits. They made extraordinary amounts of money. You know, so I think the MMTers have a point. But actually, if I can just chip in here, so in the chat, I have posted a chart from Hussman Advisors. And if you look at the valuation of the S&P 500 versus its discounted cash flows, at discounting its cash flows at 10%, and you work out what is fair value, then it is the most above fair value it's been pretty much ever. And so, yes, the S&P 500 has done very well and could well be liquidity, but I just think valuation at some stage matters. And all the forecasts that the earnings will continue to grow. I mean, I just don't. Margins are already very high by historic standards. So I just don't see how that's possible unless you get a surge in economic growth. Now, going forwards, I think trend economic growth in the US, I mean, it's higher than it is in the UK, but it's about 2.5% historically. And I don't see how you're going to get that without a step change in productivity. Now, maybe AI will provide that step change in productivity, but I don't see it. So I think the market is fundamentally overvalued. Now, obviously, I've not had a good year, but when the way I've made my money previously is, you know, when the market just seems overvalued, get out and wait for, actually, in my case, can be a few years, and then so I've got a new phone, and it seems to be identifying things I'm saying and like setting Google off. Apologies. But when the S&P 500 is overvalued, just get out, and something happens. There will be opportunities to buy it when it's cheap. Right now, it just looks ludicrously expensive, and you know, your betting is going to get even more expensive. It seems a dangerous bet to me. I mean, Simon's played this very well.
Well, my original thesis was to protect myself from inflation, And that's what Rogue said at the beginning a few minutes ago. I mean, this is all inflated money as far as I can see. I mean, I don't know. Does your valuation from Hussman, is that a real after deflation, or is that all current? I mean, the historics has got to be all nominal there. So to me, you know, if there's so much money floating around, then it's all a bit. We're all a bit in an imaginary world of inflated money, and that inflation could well go up further. I mean, a bit like the gold price. You know, suddenly the gold price takes off. I mean, I don't think it's an inflation issue. That people are buying gold. I think it's because of central banks. But even so, you know, if the stock market is riding a wave of inflationary imaginary money, I mean, it could go higher.
Well, of course, but I mean, the thing is, in inflation, really, there's not much inflation. When you look at exclude shelter from US CPI, you get well below 1%, sorry, 2%. And you know, trueflation in the US is at like 1.1%. So inflation is fading. I mean, the advantage the US has got is that it has allowed all these illegal immigrants into the country. So its labour supply is very good, better than, you know, the UK and Europe. And that puts downward pressure on wages in a way that hasn't happened in the UK and EU. But in the US, there's really not much inflation.
And energy is deflationary in the States, isn't it?
It is. Now, today, on that point, today I put out a short podcast on oil. And in digging through the numbers, I looked at the IEA forecast for the oil balance cut over the coming years. And that is quite salutary, frankly, because the IEA is forecasting that capacity will increase much more than demand in the coming years. And actually, it doesn't look, if they're even remotely right, it doesn't look like OPEC will have any pricing power, and the oil price is going nowhere. So historically, you know, I made a lot of money out of it, and which is very volatile. But going forwards, unless shale really starts to roll over, and then even if it does, it looks like the oil market will be well supplied for the next few years at least. So I can't see a spike in the oil price unless you get a big Middle Eastern war.
Yeah, I think on the demand side, China's the kind of switch or swing demander, isn't it? But I read an article, I forget when it was, a few weeks ago, that China is switching to compressed natural gas for land transportation instead of oil. Now, that could take a hell of a lot of demand out of the equation that everyone was forecasting if its economy returns to a significant amount of growth. So the picture on the demand side too, if that's true, looks pretty soft as well. And you know, if the US is oversupplied at cheap associated gas or associated oil, if you like, then you know, the price, future prices in the near to medium term look pretty soft to me.
Yeah. So I've just posted to the chat a chart I'm going to bring in this week's weekly, and that is Chinese oil demand. And you can see this year it's actually negative. Now, nobody was forecasting.
Yeah, exactly. Well, the article I read says that's mainly a lot, or not just to the economic situation, but a lot to switching from oil usage to compressed natural gas.
Oh, right. But we know that China is at the heart of a switch to EVs as well. And so what you're seeing in the US is that although miles traveled have hit their pre-COVID peak, the gasoline consumption is 5% below pre-COVID. So even in the US, where it hasn't been actually that much switching to EVs, higher fuel efficiency and EVs combine to mean that actually oil demand for gasoline is not what it was. So, the forecast for oil demand could well turn out to be soft. And my concern about the oil price is that, since I've been doing this podcast, various commentators who have gone through the underlying data, I'm thinking of Art Berman and Rosenthing and Goering and Rosenzweig, have gone through the well by well data in the US, and they came up with predictions that US shale production per well was peaking, therefore US shale was soon going to peak. And they've just been entirely wrong. I think the trouble with a lot of these oil commentators is they really want the oil price to go up. And so they interpret all the data through this lens of the oil market's going to be tightening. But the reality is that we have grown oil production from 60 million barrels a day in 1980 to 100 million barrels a day now, despite all the prognostications of peak oil, etc., etc. It shows no sign of peaking anytime soon.
Yeah, I think all these commentators on oil are also caught up in the depletion. They don't take into account potential efficiencies or potential technology breakthroughs or potential discoveries around the world that can fill the and keep the aggregate overall supply curve increasing. They look at regions and say, okay, this region, however important it is in decline, and therefore oil has peaked. But price determines everything, and since 30 to 40% of oil is left in the ground, if the price goes up, someone's going to find a way to get maybe 10% of that oil out of the ground. That's even on discovered reserves.
Yeah.
So there's a lot of flexibility in the oil supply market dependent on price alone. And if they can't take that account, which they can't because we can't predict the price, then because there's so many moving parts, then oil supply prognoses are just so much dream stuff in my view.
Well, I agree. And the other thing that I had been vaguely aware of, but the numbers I thought were quite shocking, was if you calculate US oil production as of 2023, then the headline number we report every week, so that's crude oil plus least condensate, that's 12.9 million barrels. That's the 12.9 million barrels a day. That is the daily production. If you include natural gas petroleum liquids, so that is essentially the liquids you get out of natural gas at the processing plant rather than the wellhead, and you include other liquids, and I'm not sure what those are, but you get it up to 21.9 million. So that's an extra 9 million barrels a day. That's an absolutely astonishing number that we when I report the crude production numbers every week, they don't include that at all.
No. I think we've had this discussion before, because crude is defined as what comes out of the wellhead at standard atmospheric pressure and temperature as a liquid, and that doesn't catch the natural gas liquids at all.
Yeah. So right now there's a hell of a lot of hydrocarbons, and I just can't see unless shale rolls over, I can't see the oil price spiking.
And something I've been thinking is, what about, this means that Saudi Arabia, etc., they'll be able to use fracking as well. So imagine, all of these places with lots of oil currently, like Saudi Arabia, well, they'll be able to get an extra lease of life from fracking, presumably.
Well, if they have fracking, fracking's been used on traditional oil wells for a long time. Where the in the case of US shale, it's essential to get the oil out in the first place. So, where it's been used in traditional oil wells, you're trying to extend the life of a traditional well. I mean, Simon knows far more about this than I do. So perhaps you want to take over, but the shale, in the case of shale, it's essential to get the oil out in the first place. So therefore, you're talking about new shale plays. Now, the ones I'm aware of, primarily Argentina. But what you need to also understand about the US is the infrastructure is fantastic in a way that it is not in other locations. Simon, what are the big shale plays?
Well, yeah, in general, the other issue is geologists, petroleum geologists, and petroleum engineers go and look for what they think is in demand.
Yeah.
So, and if they come across, something and it's producible, like the shale basins in the US, then they found a technology to produce just that. Now, oil shale is a relatively new production horizon. So if it's been found in the US and someone goes and looks for it elsewhere in the world, then there could be massive resources of shale oil anywhere else in the world. And in fact, Algeria, Sonatrach, have recently signed agreements with US oil companies to do just that, to look for shale oil prospectivity in Algeria.
Right.
And a lot of that can be either standalone, as it is in the States, or it can be beneath the oil, i.e. the oil source shales of the producing horizons that have previously been discovered in oil production regions. So people like gas, like natural gas, we always thought of it as waste. So no one looked for natural gas. I worked for a company in the North Sea that kept all its natural gas as stranded assets. And when British Gas turned into a private company and its monopsony was disbanded, suddenly we had a new business backed on the back of clean energy to produce natural gas in the southern North Sea. And we had a new business for that company. So it depends what you go looking for,
Yeah.
Wow. So I think the entire panel here is bearish on oil. And so, yeah, I mean, that's a good thing, I guess, for the overall
It is.
overall prosperity.
Yeah.
So right, so I'll go and just finish the US part here, and then open up to questions and comments, I guess. And so here's the macro for the US, and really, for me, although lots of people are saying, "Oh, they've dropped rates," that means we've got a recession coming. I mean, to me, I think the US looks very strong, at least just from my headline numbers, because it's got great GDP growth. It's got, this is my own little estimation I've done, but it's got relatively okay inflation at this is the last quarter of 0.2%, and I've done like an estimate of say 2.7% there. It's got an unemployment's low, And then here we've got going back to the year 2000, so you can see a comparison. So really the basic headline numbers, the economy's looking great. Plus they've got all the best stocks in terms of AI and all these new technologies, and they've got the internet market of the world completely cornered already. And plus they've got all this really cheap hydrocarbons. They've got loads of natural gas, really cheap natural gas, loads of oil. So for me the so when I look at the US economy, it's looking in great shape actually. So that kind of, for me, the current trend seems reasonable to continue actually. But personally, I don't see it. I don't like this. Simon was saying 20% yield, but I measured it actually at 41% yield. To me, that's not believable. But I do find this 16% gradient quite believable, given the facts about the US economy.
Well, I don't think the stock market can return 16% per annum. If you believe that real economic growth is, let's say, 2.5%, let's say let's be generous, 3%, and then you have 2% inflation. So let's say nominal GDP growth is 5%, and then what's your real return on equity? It is not 11%. It's just way too high. I just do not see how you can get 16% with 5% nominal GDP growth. Now, on your point about where we are in the cycle and the outlook for the US economy, I mean, if I have got myself in terrible trouble assuming that higher interest rates slow the US economy, and they haven't. Now, where are we? I don't see a recession in the US. I mean, I look at the data every week, and what I'm seeing is that the labor market in the US is slowing, but GDP growth is very strong, and there's no sign of it slowing. But I also think you shouldn't underestimate the financialization. When you look at what real earnings are, particularly for the poorer members of US society, they're not great. So poor members of the US society are increasingly financially stressed, but the middle and upper classes are doing really well out of the stock market. So if the stock market were to turn down, then you could see the US economy slowing. But the stock market's doing incredibly well. So I'm with you. Currently, I don't see a US recession. I would love to see a US recession, but I don't see it.
So okay, I'll move forward to first of all the yield curves, and they're dropping interest rates. This is the US yield curve here, which are measured on the 21st of September. But obviously they're dropping it at the low end. And my kind of gut feeling is that with all the fiscal indiscipline and I can see it increasing on the long end, but shortening a bit on the short end as they lower interest rates, leading to a corrected curve, a normal curve.
Well, from 3 or 4 years out, that's looking like a normal curve. The thing is, the US fiscal deficit is extraordinary and unsustainable, and at some stage they need to bring it under control. Now, another way to look at the US economy, they've got no inflation, So inflation is trending down towards 2%. As I said, if you exclude shelter, it's below 2%, and they're running a fiscal deficit of 7%. Now, if you start actually trying to control the deficit, cutting expenditure or raising taxes, that will tend to slow the economy. So I think they've got themselves in a bind. It's very easy to increase public expenditure. It's very difficult to cut it, because then you need to instigate some form of austerity, basically. And right now, there's no appetite for austerity or fiscal rectitude in the way that there is in the Office of Budgetary Responsibility. And let's see, but you can't carry on running a fiscal deficit of 7% ad infinitum unless you have absolutely extraordinary economic growth. And I don't think anyone is forecasting that. So, you could well be right that there's a big accident in the US bond market, but right now it doesn't look like that. And the other thing is, the history suggests that when you have an independent when you have a central bank and in a developed economy, then the one thing you want to avoid is a spike in interest rate. And what's happened in Japan is the central bank just prints a hell of a lot of money. And so what you then get is not a spike in interest, but a decline in the currency. So in that case, you wouldn't get a huge spike in bond yields. You get a bit more inflation, but a huge fall in the dollar.
Yeah, so, and there's obviously, actually lately there's been talk of the yen carry trade collapsing. Although it didn't seem to have affected things as badly as people thought. But still, yeah, perhaps the system breaks down and then a weakening dollar forces them to increase interest rates and then triggers a recession.
Well, the thing is, Rogue, I say a weakening dollar, I don't think that's a weakening dollar. The US, I don't think they'd care very much, frankly. It would add to inflation, but I think they'd treat it as everyone else's problem rather than theirs. In that, if the dollar goes down, so, if you've been to the US recently, the US is incredibly expensive for everyone, for Brits. I don't think they'll care very much, actually. What would they really care about is a spike in bond yield. And, we're not that currently, US yields are much lower than UK ones. And the UK is running a large deficit, but it's not 7%. And more importantly, we've got plans to bring it down.
I guess my kind of summary for the US is that it's all doing amazingly well, but it's kind of on the rest of the world's back. So, so unless there was some kind of breakup of the US dollar system, controlled over the world financial system, where currently the US dollar is the reserve currency, it's hard to see. It's hard to see. It just looks like good times continue, I guess. And PHS has said that trade is, and hi, good to see you, PHS. He said that trade's too small a part of the US economy for changes to the dollar to have a significant impact on the economy. What would replace it? Right, I'll move over to the UK then. Quickly, here's the US numbers, raw numbers. PHS is posting the question, what would replace the US dollar? And I don't know. So we'll kind of come to this later, but in a way, I think it's down to the. Let me load this up. the world's fiat banking system, and so I don't know. I just think that the entire, obviously the US can get away with a lot of fiscal indiscipline and lots of printing money and kind of artificial playing around with the economy, because they're in this privileged position of being the world reserve currency.
Mm.
So okay, so in terms of the FTSE 250, and here's the long-term chart, and you see that we've been in this gradient ever since the financial crisis.
Mhm.
And when I zoom in, as we discussed last time, we seem to have this double bottom, and we seem to
Yeah.
be doing really well from
Yeah.
this. So that seems to be what's happening with the FTSE 250. The after a very we've had 4 years of kind of pain, of course, before then,
Yeah.
but that seems to be what we're doing now. The FTSE 100 is really just a proxy of the world economy, because 70%, only 30% of its revenues are within the UK, and it's dominated by just 3 or 4 stocks that have most of the market cap. So it doesn't really tell us anything. It's just carrying on regardless.
Hmm.
And then in terms of the UK macro, it's a little bit not as good as the US. So we've got, I calculated the latest 1 year running lagging kind of GDP growth at 2%.
Yeah.
Unemployment's good at 4%. But inflation's, I've calculated it at 3%, based on a
Yeah.
doubling of current numbers, plus I included the previous two. The latest quarterly was 0.5%. So we're kind of mild stagflation kind of
Yeah.
situation, and but the stock markets are doing good, and house prices are stayed up. Unemployment's low. So really, the US is the UK is ambling along, and my general gut feeling is we're in like a 2009 kind of situation. I've got deja vu 2009, because I can remember after the last financial crisis, there was lots of doom and gloom on the news, and a bit like at the moment, there's lots of doom and gloom on the news, but actually we'd kind of worked our way through a recession, a mini recession, and although we were slow and we lagged behind the US, I think we're going to things are going to improve from here. Is kind of my gut feeling, my kind of base case scenario at the moment. So anyway, that's just my base case. So what are your feelings?
Well, the thing is, I think when you look at the performance of the UK economy over the past few years, it has been really poor. And I'm going to post a couple of slides in the chat that I'm going to have in this week's weekly. And the second one is for UK productivity growth. Now, productivity is creation. And the bottom line is, if you look at that chart, there has been a clear break in the trajectory of UK productivity before and after the crisis. And we are just not growing very well. And I can't see that. I can't see anything to change that trend. The other chart I posted was a table of the average and median UK GDP growth in the last 7 decades. And you'll see that we've never grown terribly well. We've never grown above 3% since the 60s on average, and it's been slowing. So I don't see the UK, I see no sign that UK economic growth is up. So, this year the IMF is forecasting 1.1%. Unless we get our investments and various other things, I just can't see UK economic growth being anything to write home.
I agree totally, and that
Simon, you're on mute, by the way.
that
Oh,
agrees.
okay.
That agrees with the even if we look at the ballpark, the headline numbers. Yeah, sorry, that's the US, is it? Yeah, it's the UK. So yeah, just like stagflationary, mild growth, trudging along, and I think that I agree with you. That's the situation, which makes sense because we've got a second-rate economy compared to the US. We've got
So in
no.
answer to PHS's question about whether the numbers in those tables, so it's showing that average UK economic growth in the 2000s was lower than the 2010s. That's because of the GFC, which kind of reduced UK economic growth in 2008, 2000 bounce.
So what I said was when you look at the UK headlines numbers, we're just trudging along, exactly
Yeah.
like you just said. But that kind of makes sense because we've got a second-rate economy. We've got no hydrocarbons left compared to the US, and we're trudging along. We've got, if you look at all the stocks in our stock market, they're all, old world things like oil stocks, banks, pharmaceuticals. Whereas the US has got like all the latest facets of a modern economy in its stocks. So we're like a second-rate economy, second-rate government, no, third-rate government, second-rate economy, and however, thanks to inflation, so it kind of makes sense to me that when you look at the raw numbers, it's trudging along, but then when you look at the stock market, it's maybe what you see here is just inflation.
Yeah. Yeah.
I mean, compared with the US, it's not as not it's not as it's not going up as much as the US, but it is going up a bit, and maybe that's inflation.
Well, what I'd say, Rogue, is if you look at small companies in the US, they're not doing well at all. Okay. And small companies in the US would equate to, medium or large size companies in the UK. The difference between, the UK stock market and the US stock market is the US stock market includes some huge global monopoly, Google, that basically earns a huge economic rent by being the default search engine for the entire planet. And the US has got all those big companies. So the US stock market does better because of that. I mean, I think, if you were to dig down in the smaller companies, I don't think that actually it's that bad in comparison with the, UK mid caps and US small caps.
Wow. So, yeah, I mean, you've got like a really financialized system generally.
Yeah.
Where there's all this power, within a small segment of private equity, I guess, and then you've almost got like the state subsidizing the kind of inequalities that is perhaps creating. But I don't know. I feel like there's a long rabbit hole you could somehow explore from there, but I've not got it on the tip of my tongue. But
well, the other thing, the other component of GDP growth is just hours worked. So the number of people who are working in your economy. And the big advantage the US has got over the rest of the world, so in particular, China, Japan, but also to a lesser extent, the UK and Europe, and actually the UK is not too bad on that, is that everywhere else has declining birth rates, aging populations. Now, this chart that Jorit sent me, this is the population of the European Union. Now, if you had zero net migration, the population starts to decline pretty much from now. Even with current levels of migration, the population is peaking. And if you compare that with the situation in the US, he says, let me just post this chart. The US is in a much better situation. The US population keeps growing until 2080. They've got a lot more land, basically, and they're letting a lot more immigrants, and those immigrants need to buy houses, etc., etc. And then if you contrast that even worse with China, which has very low immigration and a terrible birth rate, China looks to me to be in deep trouble. The current birth rate continues, and bear in mind a lot of this is baked in already, in that how many 20-year-olds you're going to have in your population from the birth rate 20 years ago, then it looks like on current trends China's population will halve in the next 100 years. So UK is not as bad as Europe, much better than China, but nowhere near the US. And so I don't see our GDP growth being anything to write home about.
Yeah, I mean, the use of immigration in order to keep economic growth happening, because the current the fiat banking system requires perpetual GDP growth, or the whole thing collapses. So immigration's been used to achieve that. It's just starting to cause all kinds of social problems, as you can see with the election results in Europe at the moment. However, I think moving forward, we're going to be able to, rather than use immigration, we'll be able to use AI robots to achieve the same effect, perhaps. So just as our demographic situation looks looks like it's about to collapse, which won't be for like another 10, 20 years, perhaps we'll be able to use AI robotics to replace the use of importation of immigrants.
Well, these problems are always solved eventually, right? I mean, in the case of Japan, which has a terribly aging population, you'll see that all the old people just keep on working. It's amazing. Wherever you go in Japan, all the low-level service jobs are done by old people.
But I know, but do you not think that? I mean, I'm expecting AI to be, it probably is like a bubble at the moment, but in the longer run, I'm expecting to see robotics used to solve the problem of not enough people, of declining birth rates?
Yeah, I'm skeptical because I mean, when you say AI, you're talking about. Would you
Well,
like your personal
robotics, not even
assistant
AI.
robot?
Well, AI actually, because at the moment, so for example, at the moment, you could probably replace 50, at the moment there's lots of jobs where you don't really need a person anymore. So
Go on, give me an example.
okay, the easiest example has got to be the public sector. So even now you could actually sack half the public sector workforce and replace it with just private sector managerial practices, and and perhaps using modern software rather than whatever they use. You could easily reduce that, but obviously the government's never going to do that, because it's good to have the people employed, even if so it's very inefficient. um, you you know People really, you don't need do you need train drivers anymore, and you know who keep on going on strike? you
Well, I
know
completely agree with you on that point.
do there's lots of in kind of office situations, there's lots of roles where there's people employed, just like before there were people employed just to use a typewriter, and then once word processing was invented, all those jobs went. I could see that robotics and AI can so with AI, another example, um, people have been using Indian call centers.
Mm,
Now a lot of that can be done using AI. I mean, you don't, you might always keep a few people just for strange situations, but 95% of the volume of calls
yeah,
can be dealt with AI now. Um,
yeah.
so actually, I went to the doctor's the other day, and found out now. I've not been for years, but I went in, and now it's you actually click on a link, and then the doctors review your problem and decide whether you get to see a doctor or not, or a nurse in a month's time. And it's all done with a link. And so you don't need these doctors. Do you remember these doctors receptionists who you'd go in, you'd have to tell them all your
Mm.
private business, why you were going in to see the doctor? Well, now you don't even need a doctor's receptionist anymore, because you just click on a link and it's all done.
So you do this online from your home?
Yeah, I initially went into the doctor's, and then the receptionist told me, "Oh no, you've got to go and do it online." Um, so, they seemed ever so happy that now they can basically just say to people, "Don't bother us. Go online. We don't even book appointments here anymore." I wonder if they realise that means their jobs might be at risk. But yeah, so I went in. They gave me like a link to follow. So now you just basically, whoever your GP is, or this is my GP locally, and it will take time to come about in different areas. But basically, you just go onto your website of your GP. There's also like an NHS Direct app as well, by the way. But you go onto the website, click a link at 8 a.m. in the morning. So actually, it's got to be, yeah. So you know that you had to phone for an appointment at 8 a.m. in the morning, and by
Oh, yeah.
3 minutes past 8, they'd run out of appointments for the day. Well,
Yeah.
now you click on the link at 8 a.m. in the morning. You've got to type in your issues, and then by 10 minutes past 8, it's kind of run out or something. But then you get a text message saying from the doctor saying, "Come in at 9:30 for your appointment." So
Hmm.
I was really impressed at how efficient that is, and
Yeah, but it takes all the human contact out of the the healthcare system. And I think one of the things that has happened to UK service industry is that we have made a choice as a society to move away from that. So to go anti-productivity growth of services. So if you think about car washes in the 1970s, they were highly automated, and then actually people decided they liked having people, other people clean them, and so now you have a bunch of blokes doing so service industries, people actually like the personal touch.
to go back to the I think we went on a bit of a discussion there, but I think I was saying maybe this is just inflation that explains why the FTSE still goes up, even though we've got a stagnant economy. And that's it, really. But what was your closing summary, Keith, for the UK, the FTSE 250 and the UK macro? What's your explanation of the stock
For what?
prices going up despite having sluggish macro?
I just don't understand it. I've got this totally wrong. So go and ask Simon. He knows what's going on. The interest rates gone up. That should be bad for equity prices. UK economy is pretty stagnant, frankly. The IMF today is forecasting UK GDP growth for 2024 1.1%. Now, we did print a load of money during COVID, and that money's got to go somewhere. So perhaps the price level of the FTSE 250 and all the stock markets has just gone up, to accommodate the extra amount of liquidity. But going forwards, the FTSE 250 has not been a very compelling investment the last 20 years, and I just can't see it being a compelling investment over the next 20 years, frankly.
No.
Well, it's been, I think the 250 has been, for me anyway, up to about pre-COVID, the FTSE 250 was my growth equities research farm, if you like. And there were a number of, if you were a stock picker, there were a number of good opportunities. Now, I think that's gone away. I agree. I don't think the 250, given the dominance of capital that's raised in the US for startups and growth companies, it's going to be pretty difficult to attract capital into the UK for new growth companies. Albeit that there are a few, like Wall Paint and Ashtead Technology and whatever. But I agree with Keith. I think it's going to be slow and difficult, and the opportunities just the US is just a magnet for all these companies, and if they start up and get to a reasonable size, they all want to go to the States anyway. So it's a difficult one.
What do you think of Persimmon,
sorry.
Tipster? Because I know you followed them in the past. I wondered, are the home builders looking attractive again to you? I'm not sure if can you hear me, guys?
Yeah, but who are you addressing?
I was asking you, Simon, if you had kept an eye on the home builders, whether you thought.
Yeah, I mean, I do. I keep an eye on all the UK markets, but haven't been involved since I switched to US dollars a couple of years ago. I might think about it again now that the pound is relatively strong and the dollar is weak, but I would hunt for income rather than, or growth in income rather than pure growth in the UK markets. Because
Right.
it's overall, like the FTSE 100, it's basically a defensive market, if you like. Banks, drug companies, commodities. So it's a different picture of a market than the US stock markets, driven by their, as Keith says, monopolies that have a dominant position globally. It's a totally different picture.
Tipsters saying car washes, petrol stations, and takeaways. So I
Yeah.
imagine Domino's Pizza might be a good one in the UK. Maybe an Uber Eats. So
Well, I
Greg's,
think he's saying that
Greg.
they're all like illegal immigrants in the UK working for cash.
oh,
Yeah,
but actually,
difficult to disagree.
I find it interesting though. Times are hard, but places that are doing well in my local city centre are definitely, if you look at those mini supermarkets,
Yeah,
Co-op and Sainsbury's, they have like a mini supermarket where everything's twice as expensive as in the proper big hypermarkets that we have. They'll have these
yeah,
city ones, and there's lots of people going in them buying their shopping at outrageous prices. And I see lots of the takeaways are doing well still, and lots of people are prepared to pay to get their fish and chips delivered to them by a guy
yeah.
on a guy on an e-bike, and I find that a kind of a bit of a sad indictment of the real economy, and it's kind of people not spending money wisely, and it's these kind of things that seem to be doing well.
Yeah.
But
Well,
we've got no kind of awe-inspiring companies doing well like in America.
I think Simon has raised a really good point, and that is, what's happened is financial integration over the last, 30 years has continued to such an extent. The US economy, US stock market has become a magnet for all the growth companies in the world. If you have a startup in the UK and you list in London, they're going to value it. And in the US, they're going to value it. Where are you going to list? You're going to list in the US.
Yeah.
So all our exciting companies go overseas, and the only ones who list here are, dodgy ones who can't get a listing in the US, or the less exciting.
Exactly. I bought some shares in Bank of Cyprus Holdings earlier this year, and they
Yeah.
were doing amazing, and then they've just delisted to go to Greece. So, so when you're losing your
That's
stocks
uncanny.
to the Greek stock exchange, it really shows you something, doesn't it?
Yeah. Oh dear.
So, right, I'll just nip through a couple of things I've been doing. One is uranium, and we discussed that at length before, but it's actually perked up, and
Yeah.
I've made a bit of a discovery. Before I was using the Numerico website to look at short-term spot price data. Okay, so it's going to take a while to load. So before I'd basically sold half, and I had like a $75 stop loss for spot price. However, what I've discovered with this lovely Cameco website is we have the long-term price and the spot price. And what I wonder now is I should have been using this all along, and I should have sold here because of the big divergence. And I'm wondering if now we'll see the price bumping up, because whenever the price drops below the long-term price, it can get snapped up in a normal market. So if we're in a normal market, then we should see the short-term price staying above the long-term price. And as long as we do, we know we're in a bull market. And I think I'll probably keep the $75 as my stop loss, and but see how it see how that develops. But I'm obviously a little bit disappointed I didn't play it differently, I guess, with that information I now know. Shell, I put in, we discussed that at length earlier, and you've explained what's going on, and I'm kind of ready to call it a day, but my trailing stop loss still hasn't been hit. So as long as it doesn't, but I guess I'm kind of expecting it to be hit, and then I'll sell my Shell.
The trouble is with the oil companies. I mean, I've made a lot of money out of the oil companies over the years by buying them when they absolutely collapse, and then when the oil prices collapses, then you're going to get a lack of investment, and in a few years' time, that lack of investment feeds through to less new oil coming through, and the oil price. The trouble now is, when they're under ESG pressure, etc., and they're investing in, wind farms, etc., those are just not very profitable. They're just nowhere near as profitable as oil. And when we talk about the UK, what the big new industries are. So you're talking about wind farms, solar farms, battery, etc., electric vehicles. In my mind, those produce no growth. You're just substituting. The amount of electricity you're producing is not changed. You're getting rid of an old coal-fired power station, and you're replacing it with wind farms. You put in a lot of capital, but your output is unchanged. In fact, your output is worse because
they're boring. They become utilities companies. So, I was looking at Star, who are investing in geothermal to replace oil, and I was thinking, do I want to own? Have I got any interest in owning a utility company? Because once they've set up a geo plant, it's in effect a utility company selling electricity at cost risen from debt brought on earlier on.
What's it called?
Star Energy. Geothermal. I wish I hadn't name dropped it now.
So this is Indonesia. My
Star
God,
Energy. No, Star Energy, UK listed.
Oh right.
Anyway, so I agree with you. Shell, the UK, actually Shell kind of started doing lots of ESG stuff for years, and then now they've kind of reverted back to just doing nothing again. They're kind of actually the best to invest in, because they kind of haven't done anything by default. They did shed quite a lot of their hydrocarbon assets, but they generally, at one point, they were going to go full ESG, but now they're kind of being a bit more conservative.
But they've had a huge, essentially, uplift in that they've cut costs and got rid of a lot of their exploration, etc., etc. But if you stop investing upstream, then eventually your business disappears.
So anyway, I'm happy to sell there if the trailing stop loss gets hit. So I recently went into some banks, and it's still in this channel. I'm hoping that interest rates stay above, say, 3%, and don't go down in the long term is my bet there. Cornish, maybe we should return to that in detail another time. Cornish metals 40% down already. I think you remember we did a video on this, or we discussed Cornish metals.
We did. I know.
So that was, I can't say you didn't try and warn me.
Yeah.
However, the tin price. So basically, if the tin price does go up, and we've had this recent, China have gone full MMT only this week, where they've announced. I mean, how big is their? I saw and I heard on Twitter that China have announced a big load of of spending, money printing. But do you know how big it is exactly? Is it just talk, or is it a sizable bout?
Okay, so they haven't announced a load of fiscal. What they've done is they've cut rates, they've cut the reserve ratio, and they have created a facility whereby banks and insurance companies, the central bank, to buy shares. Okay, but if you've been watching the weekly, where the Chinese economy is not doing, and the analogy is very much with Japan in the 1990s after the bursting of an enormous property bubble. And what happened in Japan in the 1990s was you got what is called a balance sheet recession, i.e. everyone's borrowed a load of money, and now property prices going down, everyone has to pay off. And so when you cut interest rates, it has no effect whatsoever, because everyone just is concentrated on paying back debts. They don't want to borrow whatever the interest rate is. So the market is skeptical this will have any effect whatsoever, and you'll have seen that Chinese bond yields continue to fall after the announcement. So the market doesn't believe you're going to get uptick in Chinese growth.
Okay, well that's my hopes dashed then, because if the Chinese were able to do a massive stimulus, great. But so let's say, if the tin price does go up from here, Cornish metals have got a chance. If, however, the tin price goes below this 32,000, you may as well forget Cornish metals.
Right. I mean, I think in the medium term, I think the tin price will go, certainly go up. Tin is very rare in the Earth's crust. And everywhere you're talking about, adding more chips to everything, AI, etc., every circuit, particularly now they've got rid of lead, then you use more tin.
Yeah. All these e-bikes I see everywhere.
Yeah.
They must use chips, so maybe that will help. So, iShares India, which we discussed.
Oh yes, well done.
Now, by the way, I had to look at I sold when we had this bit of a wobble the other week. The one thing, I didn't actually sell anything, but I was a bit panicked, and I did close my iShares India position. And it's unfortunately, since then, it's gone up considerably more. It's now, I took this bet, I don't know, in May, I think, and it's gone up a good 30% now or something. Sorry, good 20%, 15%, say. And I only got a 9% out of it because I closed my bet early. And this is the problem. The problem is now, and it's actually even today, it's been racing higher. I kind of, this was supposed to be me using a spread betting account to simulate a proper position, but unfortunately, I find myself spread betting, because it's just so easy to press sell. I just can't hold the discipline that I'd have had if it had been an ETF I invested in. So this is a trouble, but still, it did well. But I find it hard to compel myself to go back in when we're at such a high point at the moment.
Yeah, I like buying when everyone's panicking, Rogue.
Yeah.
I don't like buying when it's going euphoric. So,
I was late coming
I
in,
got it
so
wrong last year. I will be waiting until the blood is on the streets, and then I always like.
yeah, I like the idea of like I say, I'll probably be selling oil soon. I like the idea of waiting for $30 oil and then going in, happy. And the same for
Yeah.
China. Maybe China is a short. So Rockhopper is kind of on the verge of maybe getting a deal. So I think, well, basically the action's going to happen anytime in the next 6 months. So
Okay, go on. So when you say he's got a deal, what? He's got a deal
with
like,
Navitas
okay.
Petroleum, and basically the if you look at Navitas Petroleum share price, they're doing great, and
Okay.
it's in their action plan. Really, within the next 6 months is when it's supposed to happen. So I guess in the next
Right.
6 months we'll see
So
this.
they're going. So hang on. If they're going to do the FID on the Falklands.
Correct.
Ooh.
Yeah, let me find
I've heard that
Rockhopper.
before. I'm just like, I'll be very impressed if they do it because is it economic at these levels? Because the thing is, what everyone forgets, we all look at the oil price and it's $80 a barrel, but what you forget is that it's $80 a barrel, but over the last 3 years we've had 20% inflation in costs. So
Yeah. There's a
something.
there's a massive upside, and I got some good data on this recently. I did a video, and I actually got some feedback. So the Falkland Islands only have a 26% tax. Is that right? Hang on.
Right. Okay.
Let me just confirm this. So let me just confirm this with a yes. So it's I just wanted to confirm that. So it's only a 26% tax rate, and then so when you look at the upside here from the market cap, it's very nice, and
Yeah.
it's $77 Brent is what they've worked it out on,
Okay.
and yeah, Navitas is scheduled to. If I can get the final investment decision. So the final investment decision is scheduled for the last quarter of this year. So hopefully, fingers crossed.
Okay.
And then finally, the global gold. I went in for the 91 global gold fund,
Very good. Well
and
done.
did that in March, and it's up 30% since then. So,
Oh, excellent. Well done.
yeah, so touched a few things. I don't know if anyone got anything before I discuss the fiat banking system. Has anyone any points or questions or?
Nope.
So okay, the fiat banking system. So did you watch the video I did on this?
I haven't yet. No.
Okay.
We've talked about it before.
Yeah. So I did a video, but I'll just kind of assume everyone knows all the stuff I went through.
Yeah.
But it's good to pick out a few basic points. So I'll just go through and so yeah, it's interesting how if you look at ancient banking, we had commodity money
Yeah.
and a small amount of demand deposit money. So in our previous videos, I'd been using the term in this slide. I've been using the term money of account,
Yeah.
but actually a better term is demand deposit money. It's basically money that is a debt that's in an account. See, I like the term money of account because it means it's accounted somewhere.
Hmm.
But let's call it, you know, okay, let's call it demand deposit money because according to the references, that's supposed to be the better term. So it's just money that's on a, you know, on a account ledger that someone owes someone, and so you still had. Thanks, Simon. Um, so we still had a small percentage of the money supply would be stored on clay tablets as demand deposit money, with most money being commodity money in terms of gold coins. And then the situation of fiat money is now there's no commodity money whatsoever.
Yeah.
What cash there is fiat money, just worthless scraps of paper. And the
Hmm.
vast majority of the entire money supply is demand deposit money, is basically debts recorded on ledgers.
Hmm.
And the key I went through this process happened through incremental stages. So we had the introduction of people using representative money with the uh, Renaissance Italy banks,
Yeah.
and then we had by the time we get to the Bank of England, we have, you know, still most of the money in the economy is commodity money, is gold coins, but there's a lot more demand deposit money and a lot more representative money in terms of promissory notes.
Yeah.
Um, and then you eventually get to the point, and then what happens is actually following the formation of the Bank of England, um, at that moment you still have commodity money, but by the time we get to 1930s England, all that money gets chased out by representative money. You only have really, by and large, representative money in circulation, and the economy is mostly now bank accounts. So you see how like that you've had these incremental changes, and what seems to have enabled this. And by the way, when we first had the Bank of England, it was a fractional reserve system. However, the fractional reserve system, even though we had a gold standard by 1930, you couldn't really call it a fractional reserve system anymore
Yeah.
because somehow the introduction of the bank being able to issue gilts it basically made the importance being on the value of the currency, in our case, pound sterling. The value and kind of confidence in that currency kind of overrided any kind of concept of trusting a particular bank, and requiring a fractional reserve. And so here, even though the money was representative money, people kind of didn't really care anymore in whether that particular bank had the gold deposits, because they had so much faith in the value of the pound sterling.
But sorry, so in the 30s, when we went back onto the gold standard.
No, this was the last year of the gold standard. So this takes us from the 18th century all the way to 1930, which was the last year that we had the gold standard.
Okay.
So
you're talking about after the end of the gold standard.
Well, even when we had the gold standard, you can't really call it a fractional reserve system anymore, because the actual banks had just such a small reserve of, it no longer was sensible to think in those terms anymore. And there's it's hard to say when that happened, at what point we no longer had a fractional reserve system. But the whole idea of fractional reserve somehow became redundant when there was so much demand deposit money in existence, and you had banks lending to each other, using through kind of financing or through debt rather than actually with solid assets or money. There seems to have been, the economy seems to have over time become just everyone was using fiat. So everyone was using fiat. So everyone was using representative money, cash, whereas before, in the 18th century, they'd been using actual gold coins,
right? Yes.
Alongside representative money. Over time, you got less and less gold coins in circulation, and eventually, everyone's using only promissory notes. And then once we go off the gold standard, the money's completely fiat. And then over time, if we go from 1931 to now the situation now is the vast majority of all the money is demand deposit money.
Yeah.
It's numbers stored on the servers of banks, and fiat banknotes are only a tiny part of the overall economy now. So all this happened for all these increments, and the main thing underpinning it all seems to be the issuing of gilts by the Bank of England, and the people attribute value to the currency, rather than value to any physical assets it represents.
Yeah.
And so here I've got my slide where I just explain how the everyone in a country has to pay taxes and have to transact in a legal tender of each individual country, because the government has a monopoly on violence.
Yeah.
Everyone has to pay taxes and has to spend using the legal tender. However, the government always spends more than it receives in taxes.
Yep.
So, we've currently got a fiscal deficit of 121 billion, or 2% of GDP per year. So, because governments are in perpetual debt always, they take care of the shortfall by issuing government bonds, and people are always happy to buy government bonds because the interest rates are good for their own purposes, particularly if you're another government that has a trashier economy, and they have faith in that the government's always going to be able to continue to collect taxes and issue bonds because it has a monopoly on violence within that.
Yep.
So this is the system, and all the participants here, we take out loans to go on holiday, to buy cars on finance, to get a mortgage on houses, and obviously the banks store that, and this is why the vast majority of the economy now is in demand deposit, stored as demand deposit money, and the banks control all of these interactions now, obviously through your phone app. When you go to the supermarket to buy your shopping on your phone, using your phone now, the banks control this. However, the central banks the banks have to keep lending reserves, which are stored at the Bank of England, and overnight, any kind of differences in tallying up any lending between banks happens here, but it's actually stored and controlled in a centralized way by the central bank, and that's what these bank lending rates are that everyone focuses on so much. And so that's kind of summarizes in terms of the money supply itself. You can see that this is the UK money supply. You can see that 56% of it is retail deposits.
Yep.
So these are people's deposits, retail deposits that are managed by the commercial banks. 90% wholesale deposits, so those are large institutions and large businesses, and only 5%. Oh, I said 10% earlier. Only 5% is actual cash, and 20% are the bank reserves. And so you see how only 5% is cash, and actually people's debt dominates the fiat banking system here, because the vast majority of all that money supply is debt stored on the bank's ledgers. And it's here I've got like an overlay of you have it's split up into public money and private money. So public money is the notes and coins are so minimal we can cross out anyway, but I've put them here. But the notes and coins in circulation are considered to be public money. But the bank reserves are, which is, like I said before, that's the 20%. That's the amount stored at the central bank. Those are considered to be public money, which is a bit strange because they're actually owned by the banks, which are private, but because they're at gunpoint or whatever, because they're stored at the central bank, they're considered public money, even though they're kind of not. So they are here. We can show you the government's reserve deposits, and we can see the gold reserves and FX reserves are actually a tiny amount compared with the reserve deposits. And then the private money, which is this is the money that's been individuals store and businesses store, legal entities store, are the commercial banks, which is the 75% of the total. That's, as you can see here, visually, is most of the money supply, and that's considered to be private money. Interestingly, as to compare, this is the GDP stacked up against the private money. It's only a small fraction, and actually the taxes and the expenditure the government incurs every year are actually, the government expenditure is actually a large portion of pardon me, of all the money. And the fiscal deficits, we know is it about 100% of the fiscal deficit is.
I've just looked it up. In the UK, is about 4.4%
So
of
I've got here
GDP.
2%. Okay.
No.
So there's a fiscal deficit per year. So per year, it's, according to when I last measured it, 2% of GDP, and that will change according to GDP and when you measure. The actual overall fiscal deficit, that must be the number you just said, I guess.
Yeah.
Perhaps. It's 100% of GDP.
Well, that's total net debt. That's total government debt to GDP.
Yes.
Not the fiscal deficit.
Oh no, sorry. Yeah, the fiscal deficit's 2%.
Yeah.
Total government debt, 100% of GDP. But there you go. You can see comparatively how the money supply and how the UK's FX reserves, gold reserves, compare with the actual money that the government's spending in GDP. So ultimately, the currency strength, all the different nations are in competition with each other, and our currencies lose or gain value based on a confidence in the ability of the government, to raise taxes and to raise taxes in the future, and also these other influencers like how much debt we have, how much GDP we have, our fiscal deficit. They obviously also influence that. But the main thing is that currently, throughout the whole world, all the populations are captive audiences. We're trapped within the fiat banking system, because wherever you live, you've got no choice but to use the legal tender.
Yeah.
And so,
absolutely.
So even though we are ever more in more debt and ever more inflation, that kind of doesn't matter, because we're only really comparing our legal tender. Our legal tender is worthless kind of anyway, other than that it's the legal tender that everyone has to use in your country, and then and it could be measured. It's measured against other countries who are in the same predicament as well. So relative to other countries, we'll have actually a relatively strong currency.
Well, I think the thing to say about fiat currency, Greg, is that what governments of the world worked out is that what really matters for money is confidence that when you hand over your banknote, it is going to be honoured at the face value. And what mattered was not was a gold coin, was the trust that you were going to be able to exchange it for goods and services at face value. And so, yes, you're right. States mandate you use the government currency. But, if you look at countries where the governments have, inflated away the value of currency, the currency keeps on being used for a long time, even when you're getting, rates of inflation at 5% a day. People still use the currency when it ludicrously to use the local. People then start using alternatives. So the reason currencies are used is not just because they're mandated by the government, but they are in themselves inherently very useful for consumers and the society.
Yes. Yeah, I agree. They're useful, and it's I mean, literally. Also, there's kind of network effects. So, everyone in the country only accepts pound sterling. So,
Yeah.
That's there's desire to transact in the legal tender. So, I mean, what's your main? I mean, look, is there anything you think I got wrong there? Any clangers or anything? Or what's your thought? I mean, the general. For me, my main kind of takeaway is, which kind of overlaps with my investing thesis, is that we're kind of stuck in this system. Like over time, there's more and more money supply infinitum because the governments kind of have to be in perpetual debt and have to debase their currencies perpetually for it to work. Because the moment you start, because it's based on debt, because the whole banking system is mostly debt, then the moment people stop being in debt, then the whole economy would collapse. Is that correct? And do you have to always grow for it to work?
Well, it doesn't have to be people necessarily in debt. It can be the government. And I think what you're missing from your analysis, Ro, is it not just the quantity of money, it's the velocity of circulation.
Yeah.
So what matters in Japan, for example, if you look at Japan, they've printed absolutely vast amounts of money, but they've got very low inflation, and they've got an aging population and a declining population. And when you've got a declining population, you fundamentally don't need much investment. So people don't borrow. So the velocity of money keeps on falling because, old people, they save, they don't spend because you don't know how long your life's. You have a fundamental surplus of saving. And this is what people always get wrong about, retirement. Saying, well, when people retire, actually less than you'd expect because you don't know how long you're going to live. And so the stock of saving is, structural with an aging population. So if you look at the case of Japan, yes, they're pretty amounts of money, but that has led to a rising stock, but because the currencies come. What governments really care about is the government's debt being, government being able to repay its debt. And if you look at Japan, they've printed loads of money, they've bought loads of debt, and artificially suppressed the interest rate. So that's financial repression. So rather than getting inflation, the outcome of a crisis could be instead lots of financial repression. And in the UK, you see that in solvency ratios, etc., and the pension solvency ratios, where the government is mandate all the pensions and all the banks. You know, that provokes an artificial demand for gilts and suppresses interest.
Yeah, so in a really well functioning economy, the velocity, so this exchange here would be like the velocity of money. How much money is spent, say, within a time period as a multiple. So you've got the money that exists, but then velocity is then a multiple of how much that is changing hands in a particular time
Yeah,
period.
that's right.
But
Yeah.
so the thing is, so when the economy's going well, there's more velocity of money, etc. And then so
Mhm.
the money supply would be going up. What I guess you could say is what's happened in the credit crisis. Sorry, then, but then also what happened recently in the Corona crisis was the velocity of money dropped, so less here. But then
Yeah.
the government made up for it by issuing
Vast amounts
bonds.
of
So actually,
yeah.
it actually looks better here. So
Mm.
it made up for it by increasing debt, which then led to more demand deposit money in the banks. So yeah, and that's what the new Keynesian economics model is. It's they want the money supply they want GDP to continually be going up forever by 2% and inflation going up forever by 2%. And in order to, and as a consequence to that, the money supply goes up. What's happened to my money supply image? My money supply image just disappeared. No, it's not. It's here. So yeah,
Mhm.
it's a consequence to that. Money supply goes up, but I guess, with the new Keynesian economics, they say they can beautifully control that by just making up for the shortfall, as was demonstrated with the Corona crash,
Yeah.
by printing a load of money to make up for the shortfall in velocity of money with printed money.
Yeah.
So the thing is, though, it somehow, like critics say, like, is it a perfect system? What's the what am I missing here? I mean, is it kind of a wonderful thing that's is it basically the best that we could achieve?
Well,
Or
it's where we are now. I mean, I think the thing is, it's evolved over time and it's the best that we currently have. But it depends on, if you think of it another way, it evolved during a period where populations were growing, where there was strong GDP growth, where there was good demand for money because and so the demand for loans, etc., was good, and you had a positive interest rate, real interest rate. Now, in the case of Japan, where you have declining population and enormous fiscal debt, government debt, which is essentially unpayable, and debt in a fiat currency system, government debt is just a different form of currency, then you could well see at some stage the Japanese economy imploding and this whole system. Now, what I'd replace it with, I don't know, but it's what we've got at the moment, where you can't we've tried the gold standard, etc., etc., and there's just not enough gold to go round. And gold doesn't. The fact that gold supply doesn't change means that when you have a recession, you can't increase the money supply to stimulate the economy, and that's one of the reasons. Question: you can't bail out the banks. So I think it's not a perfect system, but it's the one we got.
Yeah, and so I mean, I could only really get my head around it by looking through all the different increments, and yeah, so it's where we got to it, just through accidents of history, really. But humans found better and better ways of managing money, I guess. And it was like you said, it required continual growth. Well, we had the agricultural and the industrial revolutions
Yeah,
were, from like the Bank of England's considered the start of modern banking, and from then we
yeah,
had the industrial revolution and the huge British Empire. And it's interesting. Here we've got in 1902, the pound sterling was 60% of world um, money supply. Sorry,
yeah,
foreign exchange reserves. And then we dwindled, and the US now dominates. But yeah, kind of by accident, we got to this system we're in now, and it's so almost kind of abstract that this situation we're in now, where where the money is basically just debt stored on computer servers, and
yeah,
but it kind of it's funny because I see there's lots of videos on this when you go invest, kind of gold bug and Bitcoin videos you'll see where they describe the fiat banking system as the reason why it's all a big Ponzi scheme and it's all going to collapse. But actually, from kind of understanding it from this angle of how it evolved and came into being,
yeah.
it's not really a Ponzi scheme, is it? It's more.
No,
And
well, the thing is, the aim is that the aim of governments is to keep the economy growing. And the trouble with the gold standard is you couldn't do that. The Great Depression was a fundamental turning point in the understanding. And so after that, people came off the gold. I mean, it took a while. We had Bretton Woods, but eventually, the US left Bretton Woods and let US dollar was no longer backed by gold, and the world economy kept on growing. So it's the commodity backing was proved to be unnecessary, and you just can't turn the clock. And I can't see what would replace the currency.
see, when you, I mean, I think that in the past, you would have, there wasn't the technology, there wasn't the power of the state to
Yeah,
enable fiat money, and if ever you had that happening, you'd have wars, and then or basically mercenaries would go and fight for the other side if they were offering gold coins. But
yeah,
the situation now is every country in the world is using fiat anyway,
yeah,
and so the technology and everything is so, and we're so more advanced now that you know there's you've got this big network effect that stabilizes it all. So everyone within a
mm,
country is going to use the legal tender because it's in their interest to. And
Yep.
and if ever we were to go back to real money, as say the gold bugs would say, and as the Bitcoin people would say, you basically would have to kind of go back to the Stone Age, because you'd be, you know, if you're back to using commodity money, that's not going to support an economy, or is it? I mean, maybe that's an open question. So if Bitcoin was usable as cash,
Yeah, frightening thought.
you know, does that require a complete collapse of the entire world's economy, you know, in order for Bitcoin to work, or can Bitcoin coexist with a modern society?
Yeah, skeptical. Anyway, Rogue, so should we start wrapping it up? Thank you very
Yeah.
much for all your work. But I don't think we're going to fix the fiat system. So it's good to, understand it.
Yeah. Did PHS have anything to say? Because he had lots to say the last time we spoke. I thought I'd like to give him a chance to make any comments.
Yeah.
So he's not responding.
Not responding.
So yeah, well, thanks a lot, Keith. It was good to catch up.
Great.
And
Well,
we'll do it again sometime. Maybe we should try and aim for like a once a quarter or something.
no, that'd be great. Did we have the next date in the diary?
We don't, but shall we
did.
plan one, say for
Yeah.
January or something? And
okay, great. Okay, perfect.
And we'll communicate. Plan one for say January. And
Right, great. Okay, thanks, Red. Good to chat.
yeah, good to chat.
I've got a quick question if I
Let us know
may.
how
Oh,
you're getting
great.
on, whether you're
Great.
still in the country, etc.
It's not.
Oh, Tipster. Hi, Tipster. Thanks.
Yeah, I wasn't sure if you could hear me because I muted myself.
Can hear you now.
Last time I did that.
I can't.
Oh, at least I'm not talking to myself.
No.
I can hear you. I can hear you, Tipster.
Expansion.
Okay, I can't hear Tipster.
Whether like interest rates have anything to do with the rapid expansion of money supply. Obviously, if you got X amount of expendable income and then a lower interest rate, you could get more debt.
So did you hear that, Keith?
I only heard the latter half, I'm afraid.
So he was saying, does interest rates increase money supply? And the answer is yes. And it's here. I've got that here because you see how the banks are lending to each other overnight. So every day, when two people have the same bank, it's easy for the bank to just change the numbers on their spreadsheets. And but when people transact with each other and they have different banks, the banks have to communicate with each other to settle the books. And at the end of every night, there's always a bit of an imbalance. And so the banks settle those differences at the central bank, and they actually use their bank reserves to do that. And the interest rate that the banks have to charge each other overnight for doing this is set by the Bank of England, who control this. And so the Bank of England, if it lowers interest rates, that increases the arbitrage that the banks can enjoy by when they lend people money. So it increases more money to be lent, and so lending more money, that leads to more demand deposit money in the system, because the banks have on their on their ledgers more debts recorded because they've lent more money. So that's how lowering the interest rate can increase the money supply by increasing the amount of lending that the banks do.
Well, I'd answer that question in a slightly different way, Wogan. Let's say that higher interest rates, they will affect the money supply and increase the government is printing money to pay the exactly at the moment.
Say that again. So I was saying if they lower interest rates, what would happen?
Oh, right. Well, okay. Yes. If they lower interest rates, you should get an increase in the money supply because, everyone lends more money, demand for loans, and loans create money. But I thought, and what's happened now, stock of debt, that when government is printing to pay the interest, sadly. Okay. Should we leave it there?
Okay, well, so see you next time, and
Great.
thanks everyone for joining us. Bye.
Yeah. Thanks, everyone. Cheers. Bye.
I do videos like this one just for fun as a hobby. It's for entertainment purposes only. Always consult a qualified financial advisor before making any investment decision.